Today we are going to talk about options Vanna. It's a very popular concept in options market today, and so what we want to do is break this down, and hopefully it will help gain a little bit of edge and insight into how options hedging works. This model is updated every day on our website. You can get access to this model as well as our daily analysis at SpotGamma.com. You can join now for a free 5-day trial. So what you're looking at here is a representation of the delta exposure for all of the options in the S&P 500, all of the puts and all of the calls. What you're looking at here is a representation of the delta exposure of all of the options in the S&P 500. So we assume that market makers, by and large, are short puts and long calls. So we look at all the puts and all the calls in the S&P 500, and we model that out to figure out where hedging flows may come into the market. So along the x-axis here, we have the S&P 500 price, and along the y-axis, we have the delta notional. So you will notice that this is a positive number. What does that mean? A positive number means that market makers' portfolios will make money when the market goes up, and they will lose money when the market goes down. Now, market makers do not want to take directional risk. So what do? They sell futures, in this case, to offset that positive delta exposure. So if their delta exposure is $1 billion, they will sell $1 billion in futures so that they are delta neutral. Now we're making some assumptions here and some generalizations, but we're just trying to push across this concept. So when we run the model, the futures price was 41.30, right? And we know that because this is where the trough is, and this is what our reference price is here at 41.30. So at this moment, at 41.30, we assume that market makers are delta neutral. So that means they have this long exposure here, this long market exposure, and they had to sell some futures, be short some futures to offset that exposure. So let's say, for sake of argument, right here, a market maker needs to sell 100 futures. They're now delta neutral. It's great. We all know that tomorrow the market's going to move up and down, right? What else do we know about the market? Well, as the price of the underlying index changes, the value of the options portfolio changes. So this red line is an estimate of the change in deltas, right? How much longer or shorter does the option position get based on the movement of the underlying stock? In other words, at 41.60, if the market goes up 30 points, you can tell that the estimated delta exposure of a market maker moves up a little bit, right? Here they're neutral, and in here they have a little bit more of long exposure, right? So they probably would need to short one more future, and that would bring them back to delta neutral, because remember, this is delta neutral. Now, conversely, if the market was to go down, you can see that, well, down around 4,100, it's still pretty flat, right? They may not have very much to do, not much of a hedge adjustment to make. What's important about this is that when the market goes up or down, implied volatility changes, right? When you are pricing options, you have to consider implied volatility. It's not enough to say, hey, what's the price of my put if the market drops 40 points and just change the underlying price. You also have to assume that the implied volatility of that option is going to change, right? So there's really two factors involved when we're just going to change the price here, right, for my option. I have to know what did the underlying price do, and then also what did implied vol do. Let's think about it this way. What does the VIX in general do when the market goes up? Implied volatility and the VIX are synonymous here, right? When the market goes up, implied volatility goes down. And when the market goes down, implied volatility goes up, right? The VIX spikes when the market drops. So if you have a huge options portfolio and all you do is change the underlying price when you're trying to forecast your risk at the start of the day, you're missing out on a huge, important factor in the pricing of your risk. You have to change implied volatility when you are forecasting your risk adjustment. So what does that mean for these Vanna models? Well, this black line here is what's called our Vanna adjusted estimate. So you can see that as the market goes down, if we change implied volatility and we shift implied volatility higher, you can see that the actual exposure, instead of being here at 4,100, the actual exposure is way up here. So this means that instead of actually being flat, delta neutral still at 4,100, they have a significant amount more delta exposure. So what do they need to do now to offset this? They need to sell futures. So as the market goes down, implied volatility goes up, the long exposure of the options portfolio also goes higher. They need to get their portfolio delta neutral. How do they do that? They sell 20 more futures. And if the market goes even lower, as you can tell, they need to sell even more futures because they need to get this portfolio delta neutral. Now, conversely, when the market goes higher, implied volatility declines. So think about this. Here we said, okay, maybe they need to sell one future. But what happens to your put options when the market goes up? Well, that implied volatility dropping crushes the value of those puts. And so when you factor in that implied volatility dropping, you see that their delta exposure goes up again in this case as the market goes up to 4160. And so once again, they need to sell, let's say, another 20 futures. So in other words, the Vanna model suggests that when the market goes down, dealers need to short futures. And when the market goes up, dealers need to short futures. And if you don't adjust for implied volatility, you are missing a good part of that picture. So depending on whether you have a lot of put exposure or call exposure, the skew or sort of the way that this line, this Vanna exposure line sets up can really change quite a bit. And so we want to show you what we mean by that. Note the symmetry here in this Vanna curve. It's pretty much a uniform mirror image. Now, if we were to shift to the QQQ portfolio, you'll note that the skew here is quite a bit different than that S&P chart. In other words, this left tail is much higher than this right tail. And this is because at the time we looked at this model, there was a lot more put options in QQQ. And so the change in the way that the exposure sets up because of the change in implied volatility as the market moves up shifts the likely delta exposure. What do we mean by that? Well, let's just take a look at this. Again, we're going to assume delta neutral here. We'll just draw this line across. So as the market declines, there's a lot of put options, and these put options are spiking in value. And so there is a lot of hedging to do, right? They need to sell a lot of futures or sell a lot of Qs to get back to delta neutral. This is their goal, delta neutral. But what you'll notice is on a rally, they don't have as much. This is a smaller amount. There's not as many calls right now in Qs, and the puts where they're in the market are at lower strikes. So this is really affecting the shape of this skew, right? And there are times where you can look at this chart and actually see that the line goes like this. So in this case, if we have this breakdown of this Vanna line, what this is actually telling you is that if the market was to go to 339, they'd have to buy futures to get back to delta neutral. So you can see that when we shift implied volatility along with price, we can figure out where in markets there is a dealer headwind or tailwind, when they're supporting price by buying futures or selling futures to sort of suppress volatility. And so at the end of the day, this is the difference of what looking at implied volatility and delta is trying to tell us, right? This is essentially what the Vanna model is. So we hope this helped to explain this model and how you may use it to get some edge in your trading. If you have any questions, please send us an email at info@spotgamma.com. You can leave questions in this video as well, or hit us up on Twitter at SpotGamma. Thanks very much.